Bonds are meant to help shelter your portfolio for when things go down. But why hasn't that been the case so much so recently? Let's dive in. So far this year, we've had a very interesting market cycle. Not to mention the last couple years around COVID, but the Fed has been very loose in their monetary policy, meaning they made it very easy for people to lend money at very cheap rates. That usually spurs the economy forward. So when inflation really started getting out of control late last year, the Fed really moved to increase their interest rate, which really is meant to cull back a lot of that lending and to really drive the economy to a halt. Now, ultimately, their goal is not to put us into recession. However, it's always a tight thing when they increase the interest rate to slow down growth. But how does that translate into investing and how we invest? Well, as you remember, or you may recall, we invest in stocks, what we call equities, and we also invest in bonds or fixed income. And at some level, there is a balance within that. So just like with a recipe with a cake, we have a different recipe based on your goals, your risk tolerance, and how you are able to achieve your goals based on those different results in investments. And what we've seen in years past has been this. We've seen that bonds can help reduce the blow to your overall portfolio. And in this graph, it's showing you the average drawdown between a bear market and the average time until recovery, and the difference between having 100% stocks and 100% bonds. Now, in this graph, again, you'll see it starts out really strong and then it whittles down, meaning if you have 100% stock, the blow to your portfolio is going to be a lot greater. In this example, it's down 34% on an average drawdown. That's 3 and almost a half years it takes for your portfolio to recover. However, if you're 100% invested in bonds, your portfolio is on average down 1%. Or it recovered in 0.2 years after a big drawdown. So how do we adapt and make sure that we're not on the extremes? Well, it of course brings back the balance idea, right? The idea of having a mix of stocks and having a mix of bonds and seeing what that does and helps your portfolio. This is a very important piece. In most cases, we're investing 70, 60, 80% of your portfolio in stocks or equities. And so what that looks like is it could contain an average drawdown of anywhere from 20% to 28%. Take about 2.5 to 3 years for your account to recover. And when they say recover in this specific graph, what they're talking about is the time it takes to hit an all-time high. So it's not necessarily the point at which your portfolio gets back to where it started. It's basically talking about when your portfolio gets back to a new high, which can, again, depend on the time frame that we are looking at. Now, what do we make of all this, especially as it relates to bonds? Well, as I said, bonds are meant to help cushion the portfolio in the event of a downturn. And so if you're 100% invested in stock, you're going to feel that a lot heavier than if you're only 60% invested in stock. Now, year to date, the bonds have helped a little bit, but they really haven't stuck out as we would like them to do. Meaning most of the bonds that we are invested in have really come down maybe somewhere north of negative 10%. And when in reality, we like them to be closer to zero or positive because they're supposed to work at some level inversely to stocks and equities. And where we find ourselves is this unique environment because the Fed has been raising interest rates while inflation has been running hot. Now, one of the biggest reasons why the bonds haven't necessarily done what we've wanted them to do is that interest rates have been a major factor to this market. Meaning interest rates continue to go up, which suggests that bonds should start to pay more interest, right? The idea of, and if you don't know what a bond is, think of this as giving your friend a loan, right? You give them a loan of $100,000. In return, they're going to pay you back at, let's say, 4% interest rate. So as they're paying you back, you're collecting that interest rate plus that principal that you originally lended them. Now, think of that in this case where the Fed is raising interest rates. So now that new loan, you can go out in the marketplace and charge 5%, right? So now the loan has gotten a little bit more expensive, but your old loan is still stuck at 4%. So in order to sell that loan, right, you have to sell it almost at a discount to get it off your books to then go turn around and sell a bond or a loan that's at 5%. So you can get more interest on that exact same amount of money. And so that's essentially what you've seen in the bond marketplace. As interest rates have gone up, the price of the bonds have come down because people don't want to buy a bond that is yielding a lot less on the same dollar amount. And so it's natural within the market for things to adjust. And what ended up happening is the bond market took an extremely heavier hit than was anticipated. And that brings me to my last point, and that is focus on the things that you can control. There is a great graph. I just want you to take one thing away from this, and that is you decide which to focus on. And in this picture, you see this big squiggly mark, and above that it says days. Next to that, you see a linear line from left to right, and it says decades. And this is meant to signify the idea of the stock market. And if we're focused on this, and all we're looking at are every single day in the stock market, then our brain is going to focus on this, which is the ups and downs and all the craziness that's going on. However, if we have the hindsight to look back, especially when we started saving and investing, then we should be more than comfortable looking at this and focusing on the decades part. So even as bonds continue to work out how they have in the past, they're still helping cushion some of the downside. We still want you to focus on the things that you can control, which are staying committed to our investment strategy and making sure that if you are feeling antsy about the market, that you're letting us know so that we can talk to you about what it looks like for your plan to ensure that you are feeling good. So I hope that's helpful, at least a little lesson on what bonds are doing right now versus what they've done in the past. If so, please help us grow the channel. Please share with your friends. Make sure you're giving them this information as we continue to help and bring on new clients so that we can fulfill our mission of helping everyone become financially free and financially successful. I hope you have a great weekend. Take care.